one of the things that we've tried to do in this panel, and which we intend to do in the future, is to use the opportunity to get views from other countries to see what we could learn from what they do, and to be sure so we can continue to tell them how they ought to run their place much more like we run ours, even though that we seem to have lost a little bit of moral authority on that lately. And the other thing is that we've tried to bridge the academic and the practical here. This is not the National Bureau of Economic Research. We're not afraid to say what ought to happen. But we also think that it's important that policymakers hear the best ideas of academics, but also that academics learn something about what it's really like to practice policy here in Washington. So for the final part of our event today, we've invited two people who are really more qualified than almost anybody else to talk about the question of uncertainty and how policymakers react to uncertainty. We're going to start with Robert Choate, who became the first director of the British Office of Budget Responsibility in October 2010. He was previously with the Institute for Fiscal Studies and the International Monetary Fund, but most importantly, he spent a decade as a journalist with the London Independent and the FT before finding more productive ways to use his time. And after he speaks, he'll be joined by Doug Elmendorf, who is, at least for a few more weeks, director of the Congressional Budget Office, a post he has held for 8 years, and of course, among his previous activities was serving as a senior fellow here at Brookings. So Robert's going to speak for about 10 minutes, then Doug's going to speak for about 10 minutes, then they'll join me on the stage, and we'll invite both previous panelists and the audience to ask questions or make contributions. So, Robert?
Thank you very much indeed, David. Good morning, everybody. It's a great pleasure to be here and to see further reminders that there is indeed a productive life after journalism. What I'm going to do today is to give you a little background to how the relatively newly created OBR is trying to address some of these issues in recognizing uncertainty in the goals that we've been given and how that's reflected through into policy. Let me start, though, just with a brief bit of institutional introduction for you. We are an independent institution created in 2010. We are accountable simultaneously to the executive and to Parliament in the UK. We've been given 4 main tasks to fulfil, the first of which is to produce 5-year ahead forecasts twice a year for the economy and for the public finances. And secondly, to use those forecasts to judge progress towards the explicit fiscal rules that the government has set itself. That's one rule in terms of a particular measure of the structural budget deficit 5 years ahead, and another rule for the trajectory of debt to GDP. And so our discussion of uncertainty should be couched in terms of what that's telling you about the government's progress towards explicit fiscal rules. The third thing we do is to scrutinise the scoring of tax and, in particular, welfare and social security spending measures. And then we also assess the long-term outlook for the public finances, much as CBO does, looking over a 50-year horizon, and also what we can learn from the measures of the public sector's balance sheet. Putting that in the US context, I mean, if you think about the key differences from this structure to the CBO OMB structure here, I guess one point to note is that all our analysis covers the entire public sector, not just the equivalent of the federal government level. We are, by Parliament, confined only to producing projections on the basis of the current policy of the current government. We're forbidden from looking at policy options. And the third thing is that the executive, the administration in the UK, does not publish its own fiscal projections. So we are the provider of the official fiscal projections, and it is for the government to comment on what we say, not for us to comment on the figures that they produce. In that context, thinking about how uncertainty comes into our work, I think as an background, it's important to bear in mind that in budget setting in the UK, the executive is very powerful relative to Parliament compared to the relationship between the administration and Congress here. And the Treasury Department in the UK, in its quasi-OMB role, is powerful relative to cabinet departments. So the rationale for creating us was very much to try to remove politically motivated wishful thinking from official forecasts rather than to help Parliament consider particular options a la CBO. And when we set out on this task, the key objectives we did set ourselves were to increase transparency and to emphasise uncertainty. Given our need to produce a highly disaggregated fiscal forecast, transparency necessarily means a lot of detail and a lot of point estimates. So why emphasise uncertainty? First, the point that we heard in the earlier sessions, that policy should reflect uncertainty rather than ignoring it. It's important because of the detail that we produce that talking about uncertainty allows you to avoid the spurious sense of precision that comes with publishing lots of detail. We can offer a richer assessment of progress towards the targets. And finally, perhaps as the first person to run this organisation permanently and having had many years mocking other people's economic and fiscal forecasts as a journalist, I didn't want to tie the success of the institution to the accuracy of our central forecast. So some self-interest in there as well. We address uncertainty in the way that we do our work and our outputs, both in a narrative, qualitative sense and also quantitatively. In the narrative, that means being as explicit as we can in the forecast presentations and publications we do as to what the conditioning assumptions are underlying the forecast and therefore what are the implicit risks if those assumptions turn out to be untrue. So the idea, for example, that monetary policy will evolve in line with market expectations and that things like equity prices, oil prices, the exchange rate are assumed to move consistent with financial market expectations. We also take care to identify what we see as being specific economic risks that may affect the fiscal forecast in any particular presentation we do. So what happens if euro area instability reasserts itself? What happens if the new taper tantrums in terms of the global outlook for the unloosening of monetary policy and the big uncertainties of what is the path for productivity and real wage growth. In the UK, even more than here, one of the key puzzles has been why productivity growth has been so weak recently by historical experience and whether that's going to reverse itself and how. We then, in addition, try to identify specific fiscal risks conditioned on the economic forecast. A key one recently is to look at what's driving effective tax rates. So the actual tax rate or the amount of revenue you're raising per pound, in our case, of the particular tax base you're talking about. One of the reasons for our recent forecasting errors is not simply that we've overestimated the aggregate size of wages and salaries, of labour income, but that also the average tax rate on that has been less than expected, partly because of the distribution of pre-tax wages. Other things that we look at: will central and local governments stick within the budgets for discretionary spending, public services spending that is set itself? And then perhaps finally, and pertinently to CBO's work, what uncertainty we see around the scoring of particular policies. And we don't provide what Chuck would like, an explicit confidence interval around the estimates from particular scorings. What we do is to provide a subjective uncertainty ranking from each policy costing that we sign off, based on the quality of the data that underpins it, the nature of the modelling that you have to do to get to an estimate, and the nature and uncertainty surrounding the behavioural response. So this is a subjective exercise, but I think merely listing those sources of uncertainty underlines quite how difficult it would be in many cases to actually put a confidence interval around a particular estimate. In addition, we try to illustrate uncertainty quantitatively. We quantify the uncertainty around our central forecast, and with particular reference to the chances of hitting the targets that the government has set itself. And I guess one thing, the combination of having an independent forecast and explicit fiscal rules set out by the government, is that in a sense we smoke out policymakers' received preference of how much margin for error they want to put in achieving their targets against the central forecast, which will be one way of saying how much do you want to overachieve in order to address uncertainty. We use three main techniques to illustrate uncertainty: probability bands around the central estimate implied by past forecast errors, sensitivity to key economic determinants, and scenario analysis. The key thing is not just to say these projections are uncertain, but how wrong does the forecast have to be, and in what sort of ways does it have to be wrong for the targets to be in peril? Just to put a few pictures on those, this simply shows you a fan chart of probabilities around the central forecast for a particular measure of the budget deficit based on the size and distribution of past forecasting errors. We do mechanical sensitivity analysis, so you take your central forecast for the targeted fiscal variables and say what difference would it make if there was more or less spare capacity in the economy, faster or slower GDP growth than in the central forecast, what if government borrowing costs, the interest rates on government debt are higher or lower. I think in that context, if you were looking for one major source of uncertainty, both around the achievement of the targets and around our fiscal projections more generally, it's the uncertainty as to what is the level of potential GDP. What is the path of real and nominal GDP to which you would expect the economy to tend if the central bank is doing its job of hitting the inflation target? And as you can see here, we all, almost everybody looking at the UK economy assumes that potential output is a lot lower than the path we anticipated it was on prior to the crisis, but there's a lot of uncertainty around how far below precisely. Scenario analysis we use in addition to highlight some particular key debates or critiques of our forecast that may be put forward at any given time, and to illustrate some areas of political sensitivity that the public may misinterpret. So what difference would it make if productivity growth in the economy was higher or lower? What happens if monetary policy tightens more rapidly than you anticipate or that the market is anticipating? The fiscal consequences depend very much on whether that's because the economy is doing better than you expected or whether it's being driven by risk premia or something like that. We can add some additional information on uncertainty and risks from measures of the balance sheet. The UK has a whole of government accounts prepared on a commercial accounting basis. That includes a list of contingent liabilities. That's liabilities that are assumed not in the central forecast to crystallise, but where there's a non-negligible chance. Things like clinical negligence costs in the public healthcare system, challenges to decisions on tax collection. There's also a list of, unfortunately, unquantifiable contingent liabilities, which we note, but there's not much more you can do with them than that. My favourite, I think, amongst these is apparently the government has a requirement to return the land for the Channel Tunnel to a suitable condition if it ceases to operate. So quite what you're supposed to do. Fill it in, plant flowers or wisteria around the entrance, or quite what, I don't know, but it's in there anyway. In terms of the long-term projections, most of this so far has been on the medium term. I think the story here is very similar to the projections that CBO produces. It, of course, allows you to take on board demographic change. We calculate debt trajectories and fiscal gaps. We have sensitivity analysis based, for example, on different population paths, different relationship between interest rates and growth, and we can look at specific issues on the tax revenue side, for example, where there are long-term trends in the average tax rate. Finally, let me note that I think we see as the flip side of emphasising uncertainty ex ante is that creates a responsibility on us to learn from our forecasting errors after the event. So we have a specific publication we produce each year separately from the forecasts in which we look back and decompose the forecasting errors and say, well, how much of this is because policy changed after the forecast, classification changes, how much of it was because the economic determinants were different, and how much was because the fiscal forecasting, specific fiscal forecasting areas are different. It's not reassuring in the sense that you still end up having been wrong, but it's quite interesting to see that this year we were wrong 3 years ago from completely different reasons for the reasons we thought we were wrong last year. So let me leave it there, and happy to take, obviously, questions at the end. Thank you.
Next. Oh, there we are. Okay, great. Thank you. Thank you all. Thank you. I will start. One quick correction for David. I've been CBO Director for 6 years, not 8. It may feel like 8 to you, and it feels like 8 to me, but it's been only 6. My colleagues and I at CBO are acutely aware of the uncertainty of the budgetary and economic estimates that we provide to the Congress. We view our estimates as representing the middle of the distribution of possible outcomes. We frequently explain the estimates that way to members of Congress and their staffs. and we often discuss risks to our estimates. So I take Chuck's concerns seriously, but in my experience, the members of Congress are quite aware of the uncertainty of our estimates. In fact, it's not too uncommon for them to think that we got the sign of the estimated effect wrong, in addition to the specific magnitude. So I think the issue at hand is not whether we should communicate the existence of uncertainty, but whether our attempts to discuss and to quantify that uncertainty provides particular additional help to the Congress in the choices that it makes. And we have worked hard in the past few years to quantify the uncertainty of more of our analyses. But there are important limitations currently on our ability to do that quantification and to help legislators make effective use of such quantification. So let me begin by discussing the things that we do and then talk about the limitations we see on doing more. So we quantify the uncertainty of our estimates in a number of contexts, and I'll give 4 examples. First, when we estimate the macroeconomic effects of changes in fiscal policies, we now regularly provide both a central estimate and a range. The ranges allow for uncertainty about the response of labor supply to changes in tax rates, the effects of changes in budget deficits on national saving and international capital flows, and other factors. And these ranges are intended to cover roughly 2/3 of the distribution of possible outcomes. One example of such analyses is our estimates of the short-term and, shown here, long-term economic effects of alternative paths for federal debt. A second example is in our long-term budget outlook. I'm sorry the heading didn't work out here. We regularly include projections for alternative scenarios. So in July, we showed what would happen to the budget if 4 key underlying factors, the rate of decline in mortality, the growth of productivity, interest rates, and the growth of healthcare costs, differed from the values that are used in most of the report. And the chapter also discusses other sources of uncertainty that we did not quantify. Similarly, we publish additional information on our long-term projections for Social Security that regularly includes a range of possible outcomes for the Social Security trust funds based on the historical year-to-year variation in key demographic and economic factors. This sort of analysis suffers from some of the weaknesses that Peter identified for similar projections from the Social Security actuaries. A third form of our quantification of uncertainty occurs in some analyses of specific federal policies. This example here is our estimates of the effects on employment of raising the minimum wage. We also provided similar ranges for estimates of the effects on the federal budget of adopting a more competitive system for Medicare. And a fourth and slightly different way in which we quantify uncertainty is to analyze how actual outcomes differed from our estimates. This is analogous to something that Robert just discussed. We do a recurring evaluation of our economic forecasting errors, which I've shown here. We have an evaluation of our revenue forecasts coming out shortly. And we also published, as the OBR does, rules of thumb for how much budget outcomes vary for a given variation in economic variables. Still, the vast majority of CBO's estimates are provided as point values without ranges. I think there are 3 principal reasons for that. First, the congressional budget process requires point estimates of the budgetary effects of proposed legislation. And Bill Hogan put this in a more pithy way than I will. But budget resolutions provide committees with allocations of funds expressed as point values. The House and Senate budget committees track the estimated budgetary effect of approved legislation using point values. The statutory pay-as-you-go law enacted in 2010 and various parliamentary rules of the House and Senate all are enforced using point values. A range that encompassed some values that complied with budgetary rules and others that did not would not be useful in following those procedures or enforcing those rules. So we do need to provide point estimates. Now, one might argue that the Congress should change its approach to explicitly reflect uncertainty. But developing comprehensible procedures and rules that use range of figures rather than point values seems quite daunting. A second reason that CBO usually does not provide ranges for its estimates is that we often lack a strong analytical basis for constructing such ranges. One obstacle is that most of the models and estimating techniques that we use do not readily yield estimates of uncertainty. They're not formal probability models. Another obstacle is that the underlying research on which we draw generally provides only limited information about uncertainty. For example, our analysis of the effects of raising the minimum wage drew on dozens of studies, so we could form an educated sense of uncertainty related to the time, the place, the modeling approach used, as well as to sampling uncertainty. But our analysis in other areas, for example, of the effects of prescription drug use and other medical spending, was based on just a handful of studies that have been done in that area. So forming a sense of uncertainty would have been quite difficult. A further related challenge is the lack of time. We are often rushing to finish analyses, and especially the cost estimates that Chuck focuses on, before congressional action on an issue is expected to occur. And doing the additional modeling or gathering the additional information needed to quantify uncertainty can take considerable time. That would delay the release of particular estimates and would also delay our turning to other analyses or estimates of other proposals. And the third main reason that we do not usually provide ranges of estimates is that we are still developing ways to help legislators make effective use of our quantification of uncertainty. Part of the challenge is that providing ranges for estimates sometimes muddies rather than enhances general understanding of our analysis. For example, when we report ranges, people who would like numbers to be big tend to pick the top end of the range, and people who would like that number to be small tend to pick the bottom end of the range. That can make the public discussion of our analysis quite confusing, and we have a limited ability to clear up that confusion. Another part of the challenge is that it is often unclear how legislators might respond to the quantification of uncertainty. And we and the analytic community more generally have developed only limited guidance in this area. Surely it is useful for legislators to be aware of the uncertainty of budgetary and economic estimates. But as I said, we think they are. The harder question is what else might they do with a particular quantification of uncertainty that we could provide. So in some cases, legislators might want to adopt only policies that are very likely to increase or decrease a variable of interest or to hit a particular target. I think this was the example that Robert gave. In the UK, if you're trying to hit a particular target for the budget deficit, you might want to pick policies that have a certain probability of actually hitting that target. We did analysis, for example, of whether a certain change in healthcare benefits that had been implemented was resulting in savings for the Department of Defense. And we concluded that it probably had. A similar analysis conducted when a policy was being considered could be helpful, but particularly in those specific cases where the Congress was trying to hit a particular target with a particular probability. As another example, in some situations, lawmakers might want to adopt policies with a smaller variance of budgetary effects in order to reduce risks to the federal budget. For example, understanding the extent of uncertainty about future federal spending that arises from uncertainty about lifespans might affect whether policymakers would want to index eligibility ages for certain programs to lifespans. In other situations, though, legislators might want to adopt policies with a larger variance of future budgetary outcomes as a means of experimenting to identify the best policies. I think analysts can help to sort out those different situations, but it's a complicated problem. As a final example, legislators might want to respond to greater uncertainty about long-term budget projections by taking larger deficit-reducing actions in order to reduce the unfavorable tail of the distribution, as Alan argued. On the other hand, legislators might want to respond to greater uncertainty by focusing less on projected long-term outcomes at some horizon. I think that more research, like Alan's paper and other papers being presented here and being written elsewhere, can help to guide policymakers in that issue as well. But the profession is still, in our judgment, in the early days of this sort of analysis. As a result, policymakers' direct use of our estimates of uncertainty is limited at this point, and that in turn leads us to devote only a limited portion of our time to producing such estimates. I'd like to conclude by emphasizing that we are working hard to quantify the uncertainty in more of our work, but there are also important limitations on our current ability to do that and to help legislators make effective use of that information. Thank you.
Well, thank you very much for both very clear and interesting presentations. I'm only going to have a few questions, and then we can maybe encourage the people who were on earlier panels to join in the conversation. Robert, tell me if I got this right, but do you have to express an opinion about whether the government has a greater than 50% probability of meeting its fiscal targets?
Yes, we do, and that therefore requires us to produce a point estimate median forecast in order to say whether they fall on the right side of that. So, yes, we do. I mean, it's interesting that the formal fiscal targets are obviously not the only thing that the politicians are interested in aiming at. We have two formal fiscal targets at the moment, and one of them isn't achievable and the other one isn't binding. So actually the government is as focused on other things like the particular date on which it expects to balance the overall budget, what the path of the deficit is on a year-by-year basis. So you're absolutely right, that's the formal role. It's not necessarily the thing that policymakers are most worried about most of the time.
I see. And there's been, Doug talked a little bit more than you did about what this is like from the policymaker side. Do you find, Chuck Mansky suggested maybe the British are just different, that they're actually interested in this uncertainty? Or does this just make you more popular with the Mansky crowd?
I think they are. I mean, partly, as I say, it is this combination of the fact that you have a clearly defined target and independent forecasting, because essentially you are requiring the policymakers, even if only by revealed preference, to say by how much do they want to overachieve the particular targets on a central estimate, which is essentially asking them to say how much account do you want to take of uncertainty in the future. I think in terms of the impact on policy changes, we have adopted an indexation of the state pension age, for example, to life expectancy. The government has set out a general principle of people expecting to spend a third of adult life in retirement, but there will be a committee every 5 years to translate this into a precise set of ages, which allows you to take into account the fact that that may be at that sort of time. But I think there is a general willingness to embrace this sort of thing. I mean, obviously the Bank of England has been doing this for quite a long time in the fan charts that it's presented for monetary policy. I mean, the issue about, I think it's important that the emphasis on uncertainty doesn't give you an excuse to dodge the responsibility to come up with your best judgment. The Bank of England used to be, or Mervyn King when he was governor, used to be so resistant to producing point estimates that he would just provide the fan chart. The consequence was that members of our former profession rushed home to the office, photocopied the inflation report, blew it up as large as they could, and tried to back out the point estimates from the middle of the probability distribution. But I think there is a general acceptance, but real politics has not been suspended in the face of it.
Doug, it seems to me that a couple of things. One is, so the reason, it seems to me one reason to talk about uncertainty is that when you're wrong, which you're bound to be a lot, you can say to the members of Congress, I told you so, even if you weren't listening, and you can cite the day in which you testified before the Budget Committee where you said. But I think the deeper question, and one that came up in the first panel this morning, and one that Henry Aaron raises, is by giving long-run forecasts, are you conveying something to policymakers that we don't really know that might, in a different state of the world than we have now, lead them to do something that's harmful?
So we've wrestled with how much weight to give to forecasts of ours of different horizons. And in fact, although our long-term projections go out 75 years, essentially all of the report that we issue talks about the next 25 years. And the 50 years beyond that, we have greatly reduced the emphasis on, recognizing that we have less and less knowledge about that horizon. But I think it is important for us to continue to do work that looks as hard as we can, takes as seriously as we can, the projection over the next 25 years. Because the challenges that the country faces are not just short-term challenges, and the policy responses that are being weighed are not just short-term responses. They are gradual responses in general, and in some cases responses that wouldn't have much or even much of it all of their effect until one moved beyond the 10-year window that we focus on. I think it's very important for us to look out over a longer period than the standard 10-year budget window. But we are very transparent in the greater uncertainty as we go out. And in this last long-term budget outlook this year, this range that we show, that I had this picture of, has debt to GDP ratios in 25 years that vary by a factor of 2 to 1. So I think we've conveyed very clearly there's a lot of uncertainty. But it turns out that essentially all of that range that we show has debt which is as large or larger relative to GDP than it is today, which is an unusually high level by the standards of the entire history of the country. And I think there's important information in that.
And finally, do you ever find yourself thinking, I wish members of Congress wouldn't pay so much attention to the score in deciding whether something is a good policy or not?
Yes, I think it is a standard view among my colleagues that too much weight is given in some cases to hitting a particular number that we recognize as uncertain and that the legislators recognize as uncertain. I think that's a byproduct of ongoing legitimate concern about the trajectory for the federal debt. But we often think, in particular circumstances, that our estimates are given too much weight relative to other considerations.
All right, let me ask if any of the authors or respondents to earlier panels want to weigh in. Gene? Can we just wait for a mic?
I'm so quiet. You wouldn't hear me.
We want to make sure we get every word down so we can hold it against you in your next confirmation hearing.
It won't be you holding it against me, but yes. I want to follow up on Doug's question there, which is, and maybe it's for both, which is, there probably are a lot of policies that you do think are good policies, but part of the problem may be that when the Congressional Budget Office says no savings, it's not reflected as we're not certain enough about it to do savings, but that it would produce no savings. And so it undercuts. And I think my question is more on kind of healthcare reform, where my guess is there may be areas where you could say, here are a number of things that probably move in the right direction, might do good. We don't have the certainty. But I guess one question is there a way of expressing without a score an opinion or certainty that these things could have a positive effect? Because you may have things that are just become almost delegitimized by their lack of their score, even though I don't think that would necessarily be the intention.
You raise an important point, Gene, and I'm not sure what we can do about it. When we analyzed, for example, the Independent Payment Advisory Board as part of the Affordable Care Act legislation, we wrote a long discussion about how this is a group that would have certain avenues open to it, and it might look for things it could do, and it wasn't clear what the group would look to. It wasn't clear how successful they would be. So our estimate of its budgetary effects was very explicitly a probabilistic sort of estimate. There are other proposals for specific changes. We analyzed, for example, a few years ago, the effects of raising the cigarette tax on the federal budget has direct revenue consequences, also would make the population healthier, and many people expect that would improve budget outcomes. We did an elaborate analysis that showed that it might not improve budget outcomes. There are factors going both directions. So I think it came through very clearly in our work that some things that seem good at first blush might turn out to be good or might turn out not to be good. I think that comes through what we're doing. I don't know what else we can do. And I think particularly in cases where it's hard to understand what the right point estimate of effects of legislation would be, to actually quantify the uncertainty would be much harder, in fact. And what Robert talked about, which I found interesting, was their qualitative characterization of the uncertainty of certain of proposals. And that's not something that we do, and I personally at least haven't thought about it, although maybe other people have, and I see Bob Reischauer, others in the audience, who may have thought about this. I'm not sure if that would help or not, and I'm not sure what our capability of doing that would be. I mean, it's worth remembering, although we are a large organization and much larger than the OBR, we published 500 written cost estimates this year. We probably did 10 times as many informal estimates. So things that are, I don't want to sound like I'm just focused on running the trains, but I am focused on running the trains. And we need to find mechanisms that are feasible on very short timetables for a wide range of legislation.
How did that qualitative, that was the one you showed the air passenger tax or something, and you had marked in yellow. Was that something that you were asked to do, or is that your invention in order to avoid the problem that Doug finds himself accused of?
Well, I'm ashamed to say I stole this from the Australian Parliamentary Budget Office, who tried it. And,
I'll have that next year.
And we've developed it beyond that. And I think what we'd previously done, we have a slightly odd system in the UK that the government, we publish the forecast, the government publishes its own scorings, which we have scrutinised before they announce them. And they know whether we'll say we don't agree with this or not. And now, having introduced this thing, what we'll say about the uncertainty around it. But previously, all we had done was to say, here is the list of 80 measures announced in this particular package. We think the following 3 are particularly uncertain, and you put a little bit of language around that. I think we felt that it would be much more useful to have a more systematic and transparent way of doing this. People are also, of course, quite interested if a particular package consists of a lot of well-identified giveaways to the general public that are highly certain, paid for by a large number of highly uncertain takeaways in anti-tax avoidance measures. So people draw interesting conclusions from that.
Peter Diamond.
Any scoring rule is open to some kind of gaming. And with the presentation of all the details, the gaming is very evident. So the people who dig in know about it, and yet the scoring rule plays a big role. And so a lot of our concerns has been, as it were, over too much. I wish you had included somebody today who did the reverse. What was life like before the CBO? What was it like without scoring when everybody was making up their own numbers? I certainly remember back the issue against Social Security before we got indexing for inflation. So the issue was, how much should we raise benefits this year, and what are the political pressures, and what kind of limits can we set on it? So scoring set the limit, but it was all made up scoring because the system had no automatics, and the scoring was made up. Here's a formula, here's a number. So Congress could hide behind the number when beneficiaries wanted bigger things. I think scoring really matters, even as imperfect as it is.
Pass the mic back to Representative Cooper.
I love the British way of whole of government accounting, and also on a commercial basis, which I take to mean accrual accounting. Because here, our austerity was really caused by state and local government that laid off countless employees as the federal government was trying to do the right thing. And also, so few of our colleagues have any idea of what a fiscal gap is, much less how large it is.
The other panelists, Steve Goss. No, go please.
Thank you. First of all, just to the point of scoring before there was CBO, at least on Social Security, there was. And Peter, we'll have to have a longer discussion about what happened prior to the automatics, because there was serious consideration of that. But my question is really for Robert. Robert, you kind of took my breath away with one of your graphs, where it looked as though from your 2008 projection, I hesitate to say forecast, to your 2014 projections, you had a lowering of your estimation of potential GDP for 2020 of approximately 15%, with no apparent trajectory in the more recent projection to be closing that gap back. So it looks like you've taken a 15% bite off of potential GDP, at least through 2020. Is that your presumption going forward? And doesn't that sound like an awful lot of uncertainty? The question on that is, do you really think your 2008 was that bad that now you really had a need for that much correction?
Shall I pick that one up specifically? The first point to make, obviously, is that the 2008 projection was before we existed, so that was the published projection when the forecast was still in political hands. Although that said, that said, I would not say that if it wasn't in political hands that you'd have been very much closer to where we are now. But I think certainly this has been true since the crisis hit in the UK, and I think it's more so here than it was to start with, that the whole notion of how big is the hole that your fiscal consolidation program has to fill in is entirely wrapped up in this judgment of how much potential GDP has moved down from the expected path. And basically for the UK, you multiply that loss by 0.7, and that tells you roughly what your increase in the structural budget deficit is as a share of GDP. Now, as you rightly point out, and as I hope the chart showed, there's a lot of uncertainty amongst other people who are looking at this as to how big this decline is, and because for a large part it's very difficult to explain quite why it should have been that large. But basically in response to the fact that, we've had a weak economic recovery, but business indicators are saying there's not very much spare capacity, you've got a very weak productivity performance, all of that suggests there's been a big supply hit. On the other hand, that view is challenged by the fact that we really still don't have any wage growth to speak of. So can the net output gap really be that narrow? But I think it's something it's important for us to be upfront about, We're in the middle of a 10-year fiscal consolidation program based on filling a gap between one number you can't estimate or indeed observe directly and another one.
How about potential here? What have you done on that?
So we've revised down our estimate of potential for 2017 by 8% or so relative to our projections in 2007. We think that some of that is due to the recession and weak recovery specifically. We think some is due to developments up through 2007 that just weren't apparent to people at CBO in 2007. Of course, as the period since the last cyclical peak goes on, as the recession and weak recovery occupy more and more of the time we're looking at, it's harder and harder to disentangle what part of the revision is due to developments in this business cycle or just a mistaken assessment by us before the business cycle. But the downward revision is substantial, and I think that does provide appropriate caution about taking a particular point estimate at face value.
Tax notes?
I'm a journalist, so I don't know how productive this will be, but
Don't start.
so this is for Mr. Elmendorf. I'm much more familiar with JCT's estimating methodology, but a big debate in that world, in the tax world, has been over whether or not to account for macroeconomic factors or attempt to project them. Right now, they're mostly just basing it off of your agency's baseline. And I was wondering what your thoughts were on whether doing the accounting for these factors would reduce uncertainty or increase it.
Let me just quickly clear up some confusion about this question of dynamic scoring. The first, as you understand, but not all the recent commentators do, our scope for incorporating macroeconomic effects into changes in legislation is limited by the fact that estimates of changes in tax provisions are the responsibility of the staff of the Joint Committee on Taxation, not of CBO. A second thing just to emphasize is that our estimates and JCT's estimates incorporate lots of kinds of behavioral responses. They're not static, but they don't generally incorporate macroeconomic effects. Another thing to emphasize, though, is that when legislation is being discussed or proposals are being weighed that would plausibly have large macroeconomic effects, then, and if time allows, then we or JCT do estimates of those macroeconomic effects. So we do this every year in our analysis of the president's budget. We did it this year for our analysis of Chairman Ryan's budget plans. We do it now every year in our long-term budget outlook. Last year for the Senate's comprehensive immigration legislation. JCT did it this year for their analysis of Chairman Camp's tax reform proposal. So this sort of work is not new to us. We've actually spent a lot of time ourselves in the last few years improving our models of the effects of fiscal policy on the economy and in writing reports that spell out how we do that sort of modeling. So doing those kinds of analyses, again, for legislation that would plausibly have noticeable macroeconomic effects, and when there is time in the congressional process for us to do it, that's fine. We're doing that now. I think the question for the members of Congress is how they want to use that information. And that's really up to them to decide what role they want to give these estimated macroeconomic effects and their feedback to the budget when they consider legislation. But that is appropriately up to the members of Congress to decide.
Another question? Yes, Henry Aaron.
This is a question for you, Doug, with respect to the alternative fiscal scenario projection, which in many quarters is regarded as perhaps more realistic than the extended baseline. Actually, one of my questions refers to both projections. During the first session, when commenting on the projections of Social Security and Medicare hospital insurance, Peter Diamond observed that the probability that scheduled benefits would be paid in both programs and current revenues would be collected in both programs was the probability of those joint events was about 0. Yet both the extended baseline and the alternative fiscal scenario assume that 0 probability event will occur and is fed into the projections. So with respect to that particular assumption, my question is, what do you think about that? And are you bound by instructions or statute to estimate in that way, or was this a decision of CBO? The other question relates to the alternative fiscal scenario only, which is the assumption that revenues will continue beyond the 10-year budget window at 18% of GDP, which is based on historical analysis, but historical analysis of a time radically different in character from the one you're projecting, one in which in the future, were we to remain at 18% of GDP, Congress would have to continually cut tax rates in the face of projected widening deficits, which even given Congressman Cooper's evaluation of his colleagues strikes me as verging on calumny, something that they would not do. So I'd appreciate if you'd comment on both of those elements of the projections.
So it is common, as you say, Hank, for people to refer to our alternative fiscal scenario as the more realistic scenario. But I don't refer to it that way. We at CBO don't refer to it that way. Because on many of the occasions we've done this, the alternative scenario has shown debt just skyrocketing ultimately. That's not a realistic projection. For our purposes, the baseline and then the extended baseline scenario are meant to correspond roughly to current law. And we think about the alternative fiscal scenario as corresponding more closely to current policies, one might say. And the difference was particularly stark when the 2001-2003 tax cuts were scheduled to expire, because members of our baseline and the extended baseline followed current law in incorporating those expirations. But many, many members of Congress were in their own minds starting from a benchmark in which the existing tax rates were continued. And they wanted to understand the effects of policies relative to that sort of benchmark. And we put that continuation of the then current tax rates into the alternative scenario. So I don't think it's meant to be realistic. So Peter's concerns about this don't worry me, because I think the alternative scenario is meant to convey what would happen if we continued with current Social Security benefits and other sorts of benefits as they're currently being paid out, and we continued with current tax policy. Now, we are required by law to follow certain rules in constructing our 10-year baseline projections. Much of this was written into law in 1985 in the Gramm-Rudman legislation, with some modifications since then. So there are rules that we follow, and when there are ambiguities, we consult with the budget committees about how to handle those. But that applies really to the 10-year projections, the official baseline. The extended baseline projections, we've tried to follow that spirit of current law as you go further out. It's not literally current law for a variety of technical reasons. So, for example, the federal government currently has a debt ceiling. We don't assume in our projections the debt ceiling is not raised. So even the baseline rules, although they're supposed to be about current law, make certain sorts of accommodations. And for Social Security, where benefits are legally paid, I understand, only if there's money in the trust fund. The baseline rules say we will project the benefits as if they were being paid, as if there's enough money to pay them. So that's the baseline. And as I say, we follow that same principle for the extended baseline. The alternative scenario is really up to our judgment about what alternative benchmark, what representation of current policies we think would be most useful to the Congress in its deliberations. But the goal is not realism. The goal is to capture what many members of Congress think of as the current sorts of things that are going on in the budget. But there is obviously ambiguity in that, and we use our best judgment in trying to be specific. And then, as you know, we lay out the assumptions that we've made very explicitly.
But in the baseline, you're required to assume that Social Security benefits are paid even if there's not money in the trust fund. Yes. Right, and then on the tax question, why 18% of GDP?
Oh, so on the tax question, what we're trying to capture there is what people might think of as current tax policies in a broad sense. So what's happened over time is that the federal government, as you know, has collected revenue equal to about 18% of GDP on average, with variation up or down of a few percentage points, but no evident trend. So we think if we're trying to show the Congress what would happen if they continued with the benefit policies that are in place and the sorts of tax policies we've had in the past and have now, what will happen in the future? And the fact that those lines of spending and revenues diverge, that is the fiscal challenge. That is exactly the point, that with the sorts of tax policies we've had before, the federal government will not collect enough money to support the sorts of benefits that we have now, given the aging of the population and rising costs for health care. And the fact that those lines diverge is our effort to demonstrate to the Congress why important changes in fiscal policy will probably be needed. And so it's not our job to line those up. It's the job of the Congress to decide what policy changes over time might line those lines up better.
With that, first, please join me in thanking these two guys for such a clear thing. I also want to remind everybody that all this and more is on our website. As you know, these events don't happen automatically. I want to thank Carrie Granis, Pari Sastry, Brendan Marchuruk, Emily Parker, and my colleague Louise Shaner for helping us make this such a success. And I'm no more certain about what the right answers are, but I'm a lot more sophisticated about my understanding of uncertainty, and I hope that's all the same true for you. Finally, people who are on the Hutchins Advisory Committee, Marty Feldstein, Alan Murray, Bob Reichauer, Glenn, like to take a picture, so if you'd come up, I'd appreciate it. And for the rest of you, thank you very much.